Good afternoon. I hope you had a good lunch. And we are here in one of the three panels, which concerns this one, MREL. So I am the moderator of this panel. I am Sebastiano Laviola, member of the Single Resolution Board, for those that do not know me. And I am pleased to invite, in order, Sofia Toscano Rico. Please take a seat here, Deputy Director General of Horizontal Line Supervision, European Central Bank. Ruth Walters, Senior Advisor at the Bank for International Settlements. And two colleagues from the industry, Stefano Porro, Chief Financial Officer of UniCredit, and Gonzalo Gazos, Senior Director, Prudential Policy and Supervision, European Banking Federation. So, as you see, this panel is composed equally of colleagues coming from the institutions and colleagues coming from the industry, one representing a big European association, banking association, and a CFO of a big European bank. What we are doing here today, and why that? Well, first of all, you know, it has been mentioned today by Dominique, by several others, the importance of the requirement on a minimum requirement of own funds and eligible liability for insurance as a first pillar of resolvability. And what we have achieved in the Single Resolution Board until now. As it has been said, we have essentially arrived at 1st of January 24 at the fulfillment that the banks had to do of the target level, that's to say, the amount of resources that had to be ready in case of failure. And there are many other areas that have been fulfilled, so close of the transition period, the fund, the resolvability expectations, etc. So the idea is to take stock of what has been achieved, to also draw lessons, some initial lessons of the recent crisis, and a general opportunity then to revise, or not, the MREL policy in the future. For this purpose, we have published a short consultation paper in mid-December that touches various areas, and the paper is deliberately neutral, wants to provoke a debate and reflections from everybody, from the industry stakeholders, from representatives of the public sector, for other interested members. On what? On what we have achieved, the direction of travel, and whether there can be potential changes in the future. And there is no deadline, I say it from the beginning, it's not tomorrow, it is not in 10 years. It's something that has to be assessed, also on the basis of the feedback that we received. And the SRB has not taken any commitment to go in this or that direction. So I would immediately start, because the time is short, and in order to have more dynamics in this panel, I will ask to selected speakers some questions. So you will see that I will ask you, but then if there is time, others can jump in. The idea is that each of you speaks 5 minutes for the questions that you have kindly been requested to answer. I will start with the first one, where I would ask the ECB and the EBF to give us some views. And this one is the following. In our view, the final MREL target, as I said, has become binding and reached a steady state. We do not have, we are positive there are no banks, except a few ones that have received the transition period, an extension of the transition period, that are in shortfall. This will be confirmed with the data by end March, but our analysts have communicated as that already from Q3 of 23. So do you think, with this in the background, that the objective of banks being fully resolvable has been effectively achieved? And there are lessons learned about the MREL journey that took various years that we should consider, ECB and EBF. Please, Sofia, floor is yours.
Thanks a lot, Sebastiano, and first of all, thanks a lot for the invitation to be here and to discuss this very interesting topic. It's a pleasure to be here. And you just mentioned that most of the banks reached their targets, and I think that's first of all a good achievement. So it's going clearly in the right direction, and I think we need to also when those things happen to also mention it, and then I think it's an important milestone. And then you ask, is the work done? And from the supervisory side, the work is never done, so we can always continue improving. And one of the things that I would like to say is that, well, we have achieved the quantitative targets on MREL, and maybe now it would be good to focus also on the quality of MREL. So where do we stand there? We should continue assessing, and I know the SRB is paying attention to that. You just mentioned the consultation paper, also where there is mentioned to further assess the quality of the MREL stack. So is are the instruments that are in that stack really available to absorb losses when they come and in a timely manner? So that's one of the things that we should look into. And as it was already mentioned also before, really trying to go more into the testing phase. So really see if a crisis would come from even from an unforeseeable scenario, would the MREL that is there available to absorb losses. The second thing that I would like to say as well is on the operationalization angle, so this one of the testing, and would banks be able to provide the necessary information if a crisis comes in a timely manner? This would be another focus of angle of focus that I would like to mention, and that I think it should be explored. Namely, the operationalization in bail-in that would have to be implemented on a cross-border scale. Would banks have the capabilities to, on a timely manner, give the resolution authorities the data that is needed? This is an area where also from a supervisory perspective, we still see room for improvement. Data aggregation, risk data aggregation in banks, and the timeliness, the speed that we would need that data, would that be available on a cross-border basis? And this would be critical to be prepared for a crisis. And then the last point that I would also like to make is the need for continuing strengthening the cooperation and coordination amongst authorities. We are doing a lot already there, both the ECB and the SRB, but also with our partners, international authorities in other jurisdictions. And I would mention this is not starting. We are doing that already for a number of years, even outside the EU with our UK and the US colleagues in the TPLE. It was mentioned this morning, I think, by Dominic, but where we really think it's important to do testing and dry runs involving all the relevant authorities, and if possible, also involving some banks. So these would be at least 3 areas where I think work should continue. We are still not there, and I would just like to also mention to finalize that. One of the lessons from the US turmoil in March was that it is important to have MREL. I think the EU made the right decision on ensuring that all banks that could have, whose failures could raise any financial stability concerns should be earmarked for resolution and should therefore build loss absorption capacity and recapitalization capacity, and therefore also for medium-sized banks it's important to have it in place and implemented.
Thank you, Sofia. Now, Gonzalo.
Thank you, Sebastiano, and congratulations for the event and the openness of the SRB in this new stage that starts after having reached the steady state. I'm not going to repeat what has been said this morning. We've come a long way, met very challenging targets, and also fulfilled some of the objectives, at least the most important ones. But now we need to take the framework to the next level, which means to make it more efficient, more simple, and at least equally robust. And I'm sure we can do that. I think Dominique mentioned this morning that it's difficult to improve something that is already working. It's a little bit what happens with the SSM, with this high-level report of the expert group, with many recommendations to improve something that is actually working. And that's maybe even more difficult than starting from scratch. But that will be a different story. Now let me tell my answer to your question, whether the objective of banks being fully resolvable has been effectively achieved. And I would say, you never know until there is a case, but I would say yes, or at least I can say that the three tasks we had to accomplish have been done effectively. First, the regulation. Second, the implementation by the Single Resolution Board with a strong determination because it wasn't obvious. And then the huge contribution from banks in different types of funds. So we can tick the three boxes because that has been done, and only hope that, of course, any bank would be effectively resolvable. Now, let me stop a little bit in these three factors. First, the regulation. Before this regulation, you will remember we had, and I remember with you, Sebastiano, we had the directive on the winding up of credit institutions that was reliant in the home supervisory scheme and then complemented with MOUs for voluntary cooperation. And it worked well in going concern situations, but it proved insufficient in the heat of a crisis. And that nuance is so important. Now we have a regulation with a clear roadmap what to do in a resolution of a bank, be it a national level or a cross-border resolution. Then in terms of what the single resolution mechanism has done, we have witnessed how the SRB and the NRAs have been working relentlessly to get everything ready should a bank have to be resolved. That's important. And I think that also makes a difference because in the past, every resolution case was an exercise of improvisation. And now we have a clear procedure to follow. And let me expand a little bit more on the third factor, what is the contribution of banks. Of course, we know all these figures, but sometimes you stop thinking about what they mean. And we really need to appreciate the effort made for a very important purpose. The banks have contributed to the Single Resolution Fund, the original target of 55 billion, plus 22 billion euro on the way because of the deposit growth in the pandemic, making 77 billion euro. This figure, to put it in perspective, is almost equivalent to the yearly average net profit of the whole sector during the last 10 years. So that's a big sacrifice on the side of the European banking sector. Put together with the deposit guarantee funds at national level, plus the resolution funds, the bank-funded contributions amount to 2.4% of covered deposits. Just to put an example, and this is not to make comparisons, but you know, in the US that figure is 1.3%, and it's now been, of course there is the potentially exposed contributions if need be, but the funds that we have already put over the table is really massive now. We need to use them for a good purpose. And I would also remark the speed at which this has been done, what has been also a big impact in the P&L of the banks. So we are very happy to have reached the steady state, meaning there is no more burden on the P&L of the banks, hopefully going forward, or not a lot. But the conclusion is that the banks in Europe are effectively resolvable using private money and resources from banks. That was the main objective when we all started with this project. Now, in terms of lessons learned from the MREL journey, I would say we have achieved the goals. The steady state is there. It comes at a big cost. The second lesson is the MREL calibration is robust, however, too complex, and we will speak about that later on. And third, let's not forget that even if we are now in a steady state, there's still a lot of regulations that will influence also the MREL and the resolution procedures, mainly the implementation of Basel III and the future macroprudential review that we will also need to take into account the impact they will have on the resolution metrics. I would stop there and go back to you, Sebastiano. Thank you.
Thank you. Thank you. Good contributions from my point of view. So now let's go to second question. And I would this time call again Sofia and Ruth to provide us some views, but also Stefano, if there is time to jump in. So here, just to put the question in context, we have already spoken about the banking failures of March 23. This will lead to an evolution of the resolution plans and maybe also the MREL targets. We will see. Why I'm saying that? Because what comes out is that you know, the crisis evolved dynamically, and therefore the strategy has to be up to the task and be used in that moment, and has to be the best possible in that moment. So this calls, as the FSB report mentions, to consider a kind of you know, optionality on flexibility in the use of the resolution tools. This doesn't mean that the more optionality means a detriment to the preferred resolution strategy. So there will be always a preferred resolution strategy and a certain tool chosen. But this tool, in certain cases, according to the scenario, can be different, can be more than one. So it is also a combination of that. And we have seen particularly during the crisis, in resolution or in what has not been a resolution, but very similar in terms of results, a role for the transfer tools. And so here the question is whether we have, and this is the SRB, at least aspiration, intention to study the use of transfer tool, asset transfer tool, in combination with bail-in, with the bail-in tool. What is the impact on MREL? Because here this concerns the strategy. What is the impact on MREL? Well, you know that when there is a transfer tool, already the policy provides a rebate, so essentially a lower amount in the so-called recapitalization amount. Sorry for the technicalities, but it works like that. Now, clearly, depending on the size of the bank, it is unrealistic to assume that certain type of banks will only be resolved with transfer tools, because the sheer size of the banks probably doesn't allow that, and doesn't allow to find, willing buyers. We have seen in the case of Switzerland that there is also an issue that has been posed of becoming even too big to fail again, because we have from 2 G-SIB, we had just one in a relatively small country. So as I said, one potential solution would be to combine bail-in and transfer tool rather than, according to the scenario, and this doesn't mean that bail-in is not important and not useful. Bail-in remains crucial, I want to say it clearly here, but maybe to accompany that with another tool in a more, let's say, systematic way. And this would provide a greater optionality and greater operationalization of the resolution strategy. Now, what are the views about considering in resolution planning more than one resolution tool or even a combination? And these can effectively increase the optionality in execution. Sofia and Ruth and Stefano, if you want to add something.
Thanks a lot, Sebastiano. Well, in my view, indeed, having optionality and flexibility is critical for the resolution authorities, because you are, of course, in resolution planning, trying to identify what is the preferred resolution strategy, but it's impossible to anticipate where the crisis will come from, what will be the trigger for the bank failure. And if, for example, the open bank bail-in is the preferred resolution strategy, and then there is a failure, triggered liquidity failure that is triggered by doubts about the sustainability of the business model, or is the bail-in tool the right tool? So I think that having optionality and flexibility is critical, and it's important to be prepared. So in my view, it would be really good to start looking at other tools and how to implement those other tools. And the transfer tools, as you just mentioned, have proven in the past, in the recent past, but also in cases like Popular or Sberbank, to be quite useful tools. In some cases in combination with bail-in or not. So. And we see that also in the US, the purchase and assumption tool is quite widely used. So in my view, to your question very directly, yes, I think it would be important to work on alternative strategies. Of course, this requires additional work, both from the resolution authorities, from banks, also from supervisors, because we contribute to that work. We are consulted on resolution plans. We are involved. But I think it's something that needs to be done. It should be done. I think proportionality is key here. So we're really trying to identify what makes sense for each case, and that's critical. And the thing is that for a transfer tool, it's not so easy to prepare into the detail, no? Because you can try to identify who could be potential buyers, but then depending on the crisis and what triggers the crisis and how the market is, how the other institutions are in the specific crisis scenario, it will be a question mark of who could be a potential buyer. And here is also where in Europe maybe we are not so well prepared as in the US, and we mentioned it before, the fact that we have a less integrated banking market also may reduce the possibilities of potential buyers. And we see that cross-border acquisitions prove to be more difficult and not really taking off. So that's another thing that I think we need to continue working on, to try to get a more integrated market that also can open the possibilities a good exit in case of a crisis situation. And then concretely on the question on what would be the impact on MREL. You mentioned there is already something there when you have transfer tools as preferred resolution strategies. In my view, and this is a personal view, but I think that in most of the cases probably the solution will be a combination of tools. So bail-in, some kind of bail-in will not be probably out of the table, and therefore in terms of MREL, you need to be prepared for being able to take a solution that implies bailing in. So I think you need to be prepared for the most demanding resolution strategy amongst the ones that are in the toolbox. So saying that, and as you said as well, bail-in will continue to play an important role, and MREL as well.
Thank you. I would agree very much on the fact that if the market is not well integrated, if there are no domestic buyers, which is the experience that we have had in the past and recently, then clearly it is more complicated to find a buyer. So this is a further element of reflection to have a push towards a more integrated European market. And now, Ruth.
Thank you. Thank you for inviting the BIS to contribute to this incredibly well-organized event. I feel that I'm slightly superfluous here because, at least for this question, Sophia has said pretty much everything that I would have also said on this topic. Flexibility, yes, is crucial, but I think we've already seen that resolution authorities are flexible. We saw it last March. Credit Suisse, FINMA was in parallel preparing to do a bail-in. They had all of the legal instruments necessary for a bail-in prepared in English and German translations. They were working intensively with the crisis management group in order to make that work if necessary. In the end, they opted for something different. There's been extensive discussion of the reasons and the pros and cons of that, but we saw flexibility. Maybe an even more textbook case, the Bank of England with the SVB UK. On the Friday night, they announced that they would put it into a bank insolvency procedure on the Monday, if nothing else, but over the weekend worked running parallel strategies, preparing both for a bank insolvency procedure, but also working with potential purchasers for a resolution transfer. In the end, they got an offer that offered better prospects for depositors, for creditors, for the public interest, so went with that. But again, we're running both strategies in parallel over the weekend and ended up with a result that works. So we've seen that resolution authorities are capable of being flexible. And optionality is the new buzzword, perhaps, in this space. It was one of the conclusions from the FSB post-banking turmoil report. But options have always been considered. Every resolution that we've seen to date within Europe has involved some kind of combination of a write-down of some instruments to fund a transfer. So we're not in entirely new territory here. For obvious reasons, the focus over the past almost decade has been on making bail-in operational, because bail-in was a new concept, because it's technically difficult, because following the great financial crisis, the focus was fairly squarely on G-SIBs and on the very large cross-border banks, where certainly a full bank transfer is not an option that we can rely on being available. We might get lucky, like the Swiss did, and find it, but it's certainly not something that we want to plan for. So the focus has been on making sure that bail-in was something that is practical, feasible, and we're still grappling with the technical details of that, and that work's going to continue. But factoring in other strategies into that makes perfect sense. But this doesn't come, this isn't costless, as Sophia suggested. It's going to make the work both for banks and for resolution authorities even more burdensome. Banks are going to have the capabilities to support combinations of resolution strategies or alternative resolution strategies, and the capabilities they may need to support a transfer strategy there's an overlap, but they could be slightly different to the ones they need to support bail-in. So it does have resource implications for the banking sector, and be interesting to hear what the banking sector thinks about that. Equally, resolution authorities' playbooks are going to become even more complicated because they're going to have to deal with these. So this is something that we have to think about when it's not a free lunch here, but it's certainly something that needs to be done, because resolution authorities, you never get the crisis that you wanted. You never get the crisis that you planned for, and if you've only got one plan, then you're going to be left maybe exposed. And the other thing I wanted to mention is smaller banks. We've been looking at larger banks, but smaller banks. And here, I think loss absorbency is an issue, and this is something that the BIS, the FSI, has done work on the ability of smaller banks to issue sufficient MREL, particularly to fund transfer policies. And here we think that recognizing the possible contribution of the deposit insurer to help fund a transfer is going to create sufficient options for smaller banks. Obviously, MREL on balance sheet loss absorbency is always going to be the first line of defense. But in order, it's becoming generally recognized that certainly smaller banks, which may still need to be resolved because they could be systemic, may have problems at least issuing the debt-based MREL that's needed. So recognizing the contribution of deposit insurers can increase optionality here. The CMDI goes partway towards this by the proposal to move towards general depositor preference, because that's going to increase the amount of the deposit insurance contribution to managing a bank failure. But we think there may also be an argument for allowing that contribution to be taken into account when setting the MREL for smaller banks, because that's going to, it's recognizing something which in practice is likely to be there, available, and it may make it more feasible for smaller banks to meet their loss absorbency and resolvability targets. We know that that's not in the Commission proposal at the moment. In fact, it explicitly says it can't be taken into consideration, but we think that if you're looking at making options for resolving, for transfer strategies for smaller banks, because a purchase is less likely to be a problem there, the problem may well be the funding of the transfer, so that's something that can increase options there. Thank you.
Thank you. Thank you also for the proposal. Stefano, anything to add on this?
Yes. Thank you, Sebastiano. Good afternoon to everyone. So I would echo what Sophia and Ruth just said. Optionality in a crisis is fundamental, in whichever type of crisis. A couple of considerations. One is readiness. The second one is actionability. And the third one is leverage on what has been already done by banks, especially in relation to the recovery plan, because we need to be conscious of the fact that banks work and will work on recovery and a resolution plan. But I will be more precise in relation to that. What I mean is the following. So when we're referring to asset transferability, we need to take in consideration that banks in the last years work on playbooks, work on dry run, but work also on resolvability assessment, right, on one end. On the other end, we worked on the resolvability and so on, also on asset transfer tool. Even more on the recovery, right, because when you look to the recovery, you look if you can sell a legal entity, if you can sell a portfolio, if you can sell a going concern. Now, which is the issue? The issue is readiness and actionability. What I mean with actionability? Actionability means that in order to execute whichever of the asset transfer tool should be sufficiently tested in a way in relation to legal implications, financial implications, and operational implications, right? Especially in a multi-jurisdiction situation, right? And the more you go granular, and the more you are adding complexity, the more the actionability is difficult. I'll give you a concrete example. If you are selling a portfolio, and you have not sufficient information on that portfolio, you will be requested to have guarantees. Is the resolution authority already prepared in such a situation to give guarantees? Okay? If the answer is yes, good, you can have that. But in order to arrive to that level of details, you need to work before, right? And you need to be ready, right? So you need to have tested that, discussed that with the banks, and then you can include that in your tools. That is an example. That should be institution-specific, right? Because depending on the institution, depending on the type of the tool, depending on the type of jurisdictions, the implication might be different. The other element that I told you is leverage on what we have, right? Because considering that some of this work is done on the recovery, as much as we can work on something that is already there for the recovery, the better it is. The last topic is clearly the incentive, right? So it's already there, but the more we can combine the buy-in with the asset transfer and the readiness and the actionability is there, it's clear that an incentive in relation to the MREL requirement is also very welcomed.
Thank you. Thank you. Good elements and food for thought. Now, let's move to question I would take together, also for reasons of time, question 3 and 4. So here we move to another aspect of the consultation paper. We have touched the potential optionality in applying resolution tools, so a combination of them. Here we move to an area which is how to reestablish market confidence after a crisis. And we have seen that some banks failed even respecting the capital ratios. And therefore, we need, of course, capital is crucial, but it is important to have various capabilities in resolution, for example, liquidity or positive assessment by markets and the bank's counterparties, particularly the bank's counterparty, that after the resolution and the financial restructuring will be put the bank back in business, and therefore there is a sufficient confidence in order to restart transaction as a counterparty with the resolved bank. So here all resolves about what is important and what are the factors underpinning market confidence in resolution. You know that we have a market confidence charge. Also for subsidiaries, not only at the point of entry, this is important, but also for subsidiaries. Because normally in a standard SPE strategy, the loss absorption and recapitalization to the subsidiary is provided by the parent through the mechanism of write-down and conversion, etc. And so we have considered that the market confidence charge, what we call a market confidence charge, which is a buffer on top of the standard MREL, is it necessary in certain cases to ensure the viability of the subsidiary? For example, in our current policy, but we are thinking about how to improve that, if the subsidiary is deemed complex or strongly reliant on wholesale funding. Why I mention wholesale funding? Because these are the funding that probably are the first to run away in a crisis. So now these two questions are, what are the main factors that for a bank to be able to sustain market confidence during resolution, immediately after resolution, and instead for the MCC for the subsidiary, if we look at the allocation of funding, so the distribution of funding within banking groups, what is the experience with what we call in our jargon internal MREL for subsidiaries? Were there challenges? Yes, no, it is not a problem. Are there structural changes to the funding model of the groups? What are the views, particularly from UniCredit in this case, and then additional elements I would like to have from Ruth, if time allows, also from Sofia and Gonzalo.
Okay, so let's start from market confidence. When there is a crisis, something went wrong, right? And so in that moment, it's very important to understand what can restore the trust. And I would highlight that the main important elements are in this order: liquidity, capital, and profitability. But when you are in that situation, and as you have highlighted, there are different stakeholders, right? Because let's say there are banks, there are financial institution investors, there are rating agencies, there are other stakeholders, because there are also creditors, clients as well, right? That's very, very important. The first important part in order to cope with that is a plan. So it's very important to have a credible plan and a reliable plan to be communicated, because there was a loss of trust. So, and that plan should be properly, timely communicated. Not at the maximum level of details, but depending, let's say, the situation of the crisis, the level of information can increase over time. The communication of the plan should include different information. So, first one, liquidity. Which are the liquidity backstop there? Which is the liquidity sources that are there? Provided by whom? Will they be sufficient in order to address structurally the situation? And such a liquidity backstop should be there not only in the moment when there is a crisis, meaning at the peak of the crisis, but let's say also after, right? Because the situation should remain stable over time, okay? So when I was referring, it's not only necessary to communicate point in time when there is a crisis, it's because also afterward, it's very important to communicate maybe with further information and with different type of details what will be done. Liquidity is one topic. The other topic is, for example, management team, right? So how the management team will be changed, will not be changed, and so on. The capital and profitability is something that can be addressed afterwards, okay? In this order. So the very, very, very important part is liquidity. The second one is the capital by definition. From this perspective, I do believe that, let's say, the capital charge is more important for, in a way, viability than not for restoring confidence, because as we experienced in the past, we know very well that we experienced crises where the capital was not really the driver, right? So the driver was something different. And so that's what, and in some situation, if you have a higher requirement, you might also be perceived riskier by the investor community, in a way. So that's why I don't believe that it's a relevant driver to be taken into consideration to restore the confidence. But after having addressed the liquidity, for sure, the capital level, that is very, very important. We discussed in this morning the topic of business model. Business model is also very important, coped with, let's say, the potential asset transfer implication. What I mean is, after having gone through a crisis, the third step is, let's say, properly communicate which is the new business model and the capacity of the, let's say, good bank, remaining perimeter, to be profitable and with the right business model. with the right business model, I'm giving for granted that at that point in time will be sound from a liquidity and capital standpoint, but also profitability standpoint. That's why I'm seeing this in this order. With regards groups and what is, let's say, the experience for subsidiary and so on. So one is, as much as possible, harmonizing the approach in relation to the instruments used. I'll give you an example. You can do internal MREL via loans or bonds. We decided to go with bonds. We decided to go with bonds because via bonds, you can apply a more standard approach. And bonds are usually instruments, and when it's necessary to deal with cross-border transaction, asset and liabilities transfer, are instruments that are more standardized than loans. It's very important to address specificities in the sense that if you look from the investor standpoint, the less specificities there are, the more standard there is, the better it is. As we know very well, in different jurisdictions, we might have slightly different laws, slightly different regulation. We have tried to be as much as standard possible in line, let's say, with the local boundaries, laws, and regulations. So as much as we can in future to harmonize also laws and regulation, the better it is. Confidence. If we are thinking on how to restore the confidence on the subsidiary, we go back to what I was highlighting before. And what is making the difference is the content of the information and the related communication. What I mean is, take a subsidiary. Restoring the confidence on the subsidiary depending on the resolution strategy of that group. That subsidiary is self-sufficient from a standalone perspective, yes or no? If yes, it's very important to communicate that, right? That subsidiary will be part of the new group or will be sold before. That's very important, right? If you are in a single point of entry, that subsidiary will be automatically capitalized, right? So will that subsidiary receive a further support? Even more support, yes or no? So all these topics are going back to what I was telling before. It's very important to have a plan, not only for the group, but also for the subsidiary, especially for the one that should access the market. And then progressively integrate the communication, not only in relation to what is important for the group, but what is important for the market or for the stakeholders of the specific subsidiaries.
Thank you. Now, Ruth, any other point to add on this?
Yes, I mean, I think coming second means I can be brief because a lot of the important points here have already been raised. Yeah, sort of you're exploring where the market confidence charge should be calibrated, and I think the flippant answer to that is your guess is as good as mine. But it needs to be robust. It needs to be sufficient to provide the operating capital, but also the funding that's going to be needed to finance the restructuring. And it's the restructuring that's going to have to be credible and going to have to be financed, and you know that could end up being expensive. FINMA already have indicated that had they bailed in Credit Suisse, they would have bailed in everything. The result would have been probably about capital at 44 or CET1 at 44% of RWAs, which is massive, but that's what they assessed was going to be necessary to be able to finance a credible restructuring of Credit Suisse, which, as we know, was a institution that failed not because it was its capital had fallen below regulatory minima, but because it had lost market confidence, because its business model was perceived to be flawed, because it was seen as a badly governed institution. So their market confidence, the MCC is really only the start of it, and has already been said, what is needed is a credible restructuring plan, the governance arrangements to support the delivery of that restructuring plan so that everybody can be confident that that's what's going to be delivered, clarity about who's in control, clarity about the new shareholders' rights during this period, a credible management team that the market is going to have confidence in, an understanding of what restructuring tools are going to be needed. So it's foreseeable that there are still going to be bad assets on the balance sheet. Those need to be dealt with, possibly through an asset management vehicle. That's going to be expensive. That's where your market confidence charge is going to be. Communication has already been said. This is going to be crucial, particularly in an area where we've seen that social media can accelerate a bank run. Social media may also continue to question a bank which has been bailed in. So there needs to be a strategy for dealing with that. And communication isn't just going to be a resolution weekend task. It's going to be a far more extended task, and there needs to be a plan for that. As already been said, so I won't labour the point, but liquidity is crucial. You have to assume that central bank liquidity is going to be needed immediately, but also in the medium term. And the fact of the central bank standing behind this newly bailed-in bank is a signal to the market that at least the central bank believes in it. So that's going to have a positive effect in and of itself. So I think basically the loss absorbency of the MCC is just the beginning of it. It can help restore the capital, but there's far more factors to credibility here, and it's the beginning of the question. It's certainly not the end of the answer.
Okay. So thanks. I would move, I'm cautious of the time, so I would move to the last question before opening the floor to those that want to put questions to our speakers or to myself. You know that in the consultation paper there was also a short paragraph on long-term policy considerations. That's to say, you know that the way that the MREL calibration is built today derives, of course, from the legislation, and there are various ups and downs, let's say, changes, adjustments that are made to take into account, for example, as we said, the market confidence, the balance sheet size, the resolution strategy in case of transfer tool, etc. So this is the way it is calibrated and built today. Derives from the legislation. It is not the most user-friendly methodology, as we know, but however, it is what it is. We thought that, I mean, said, why one day, not today, because there is nothing in the legislation that allows that, but why not to think about, in the long term, to something that would be to have an harmonized minimum, so equal for everybody, with only one adjustment, which is a kind of holistic adjustment for any type of modification that you might need, and that maybe could be linked also to the resolvability assessment of the entire bank. So not only MREL, but also other aspects, so to work also in the sense of an incentive, no? In various directions. This is, as I said, it is not in the current framework, so would require a change in the legislation, and it is on a multi-year horizon. But so the question is, views, and this is for Gonzalo particularly, representing the industry associations in general, how do you assess the complexity of the framework, the calibration methodology, which type of simplification, if one day were possible, should be needed? Thank you.
A very interesting question, and of course complexity is one of the common features of European regulation at large, and in recovery and resolution it is even more complex because MREL is inherently complex, so it has to be. But then it also inherits the complexity of the framework where it sits, because the legacy framework of capital is also very complex. This is all because of the many buffers that have been developed during years in Europe. So I think if we want to be effective about simplification, we need to work on two areas. One is the MREL definition. I will refer to that in a minute. But before, on the buffers and the capital framework. And there is an opportunity now that the macroprudential review is going to be launched to reconsider some elements. That, by the way, it's now being done by other jurisdictions. So there are times for everything. At the beginning was the regulatory reform. We had to put a lot of things, and at the end, an unintended consequence is that the result is too complex. Successful, but too complex. Look, for instance, at the UK, the speeches recently by Sam Boots about this bufferati idea, meaning let's condense all those buffers into something that can be more meaningful. We need to work in that direction. Let me drop an idea. There are some buffers at the Basel level. We wouldn't touch those, or it would take a longer term. But we have this OC buffer that, by the way, in some jurisdictions has not been used. In Europe, we used it with a sizable amount in more than 180 banks. And then there is the systemic buffer at national level. And they are both meant to tackle systemic risk. There are nuances, but systemic risk, after all. And they are both subject to the discretion of local authorities. Couldn't we merge them and reduce them, by the way? Or if we are going to use them for future systemic risk, maybe we can use what we have already in the OC buffer. That's just an idea, but there are many others that we cannot review at this point. But then there is the question of the usability. This paper was very enlightening, the paper of the SRB that was drafted this year following another paper of the European Systemic Risk Board. And after reading it, the constraints between the capital framework, risk-weighted, the leverage ratio, and the MREL, it's a very interesting reading, but after that you think we really need to make this more easily understandable. So very happy to see it, because this will need time to define something that people, even bankers, we can understand. But one of the findings there was that the usability of the buffers that we have ranges between 30% and 70%. Put the other way around, all the capital that we have put there is only usable in the other part, in 30 to 70%, meaning there is between 30 and 70% of the capital that we put that it is lost for regulatory uses. So we need to work on making the capital that we put more efficient for the purposes that was meant. And then there is these solutions. The solutions that are suggested in the paper are about increasing the issuance of AT1 or Tier 2. That's easy, but it's more on top of what we have. And we think that we are already at a level that is way above the point of reference of the international TLAC standard in terms of MREL, and also in many banks. So I think we have a very ambitious level of capital and debt. And another point that we need to look at, that it might be a little bit overlooked in the papers, is the importance of the MDA. At the end, when the crisis of the pandemic, we made a question to the ECB when the ECB said, let's use the buffers. And my first question was, does that mean that you move the MDA level? No, we can't, because that's in the regulation. So we need to have a look at that, because you speak to investors, and it is the distance to the MDA level, and Stefan, of course, knows it very well, what really matters. We need to work on those aspects. And then the idea of a single adjustment driver is welcome, because it is an open question that we are not going to close in this panel, but it's interesting. However, let me say, it would need a governance to make sure that all authorities involved, the supervisor and the resolution board, that you work together. And if you put together the loss absorbing amount with the recapitalization amount and also review the market confidence, then there is an opportunity for cooperation to come up with a single measure. It would be a kind of Pillar 2 assessment, holistic. After all, in principle, it's not bad. It's in line also with what the SSM is doing. But there should be clear conditions. For instance, Pillar 2 in the SSM was a success story in terms of converging from 20 different supervisory approaches, but again, it was too complex. And then the high-level group said, you need to simplify it. The SRB has the opportunity to jump to the second stage and come up with something that is holistic and simple at the same time, easily understandable by the banks, by the stakeholders, that it has to be also predictable by the CFOs, Stefano, so that you can expect what the requirement will be next year, and transparent and respecting the principle of proportionality. With those conditions, I think there is ample room to work on this proposal, and we look forward to engage with you on this topic. I'll have other things to say, Sebastiano, but I let you moderate. But if there's time, there are...
Well, since now, I think at 3:45, we have a coffee break before the final session for all the panels together. So the results of the panels, the three parallel panels. I would like first to open the floor to participants to see whether there are questions from the audience, and then otherwise we can continue for a few minutes. So are there any participants that would like to make a question to our panelists today, or on the consultation paper in general? Raise your hand so that the microphone can arrive to you.
Well, I'm here. Sorry.
Here.
Jean Postwick, BNP Paribas. Thank you first for the consultation, which is really welcome. And the industry, I think, is very happy with that kind of consultation. Besides that, well, let me seize the opportunity to raise the question about the existing policy for banks whose resolution strategy is based on transfer, where your policy anticipates a reduction of balance sheets for the recapitalization amount by something between 15 and 25%. Why are you taking that into account for mid-sized banks, basically, who may not have any subsidiary ready to sell? And why are you not doing the same for large groups who have subsidiaries that are easily separable and easy to sell, especially if you combine the tools?
Yes, thank you. It's Eduardo Vela from BBVA. The question is very, very similar to that one. We are convinced, and we were very happy to see the combination of the transfer with the bail-in, because probably that is what in real will happen. Sometimes when we think in our case, we say that if I were the resolution authority, I will sell before making a bail-in, and after selling, let's see how much bail-in is needed. So at the end, it's a similar question. I mean, this is something that at the end will be the real situation, so it should be the one used to calibrate the real MREL needs on this transfer, because in our case, multiple point of entry, we have multiple choices to sell different subsidiaries ready for that. Thank you.
So again, the question. SBMP. So we cannot hear very well from here, but the question, as I understand, is, at least for the second person, is on, if I understand correctly, if there is a possibility to have SPE and MPE, I mean, together as a strategy, or one the variant of the other. This was the question. But selling subsidiary as part of transfer strategy, I mean, these in principle can be done. Well, there are some constraints in the legislation, but if it is a complex which depends in an SPE strategy, depends directly from the parent company, in principle, it can be done. So I would say that the difference between an SPE and an MPE, where you have, different subgroups in the MPE which have to look for funding outside of the main group, so independently of the parent, and there are very few interconnections, if at all, so the subgroups in an NPE have to be resolved by themselves. The difference is exactly the fact that the funding, and therefore any losses, even in selling, in the case of SP, in selling a part of the subgroup, they all have to go to the parent company, because that is the single point of entry. While in a NPE, this works by definition in a different way. So this is the main difference, I would say. It then depends on the real situation of the crisis. But the fact that you have an SPE and that you cannot sell at all any subsidiary in resolution, well, it is not something that has been written anywhere, but it might be possible if viable. And in any case, in the restructuring, when there is a restructuring after resolution, normally there is a restructuring plan, and probably changes in the business lines, and therefore probably some changes in the composition of the group. So it is a question to be effectively prepared, and eventually, if it is possible, to have this selling even anticipated where possible. But of course, it has to provide value in the direction of having the entity that remains to be more resolvable and to be viable after resolution.
No, that's clear, but I think that we are making very similar question. In the case, regardless you are SP or MP, you have a valuable subsidiary that could be sold as a part of a transfer strategy. On top of, we have the bail-in tool as the main resolution tool, but this should be considered. I mean, this is at the end, it's the first part of the consultation that you are making. The combination of transfer strategies, I think it's a good idea and opens this kind of discussion. I think regardless if we are single or multiple, the thing is that we do have a good business that can be sold. And if that business is within a subsidiary structure, it's easier to consider and to calibrate than the MREL having that or bearing that in
but you see, I would say that if a subsidiary, as I think UniCredit said, if a subsidiary is an integral part of the business model and of the viability of the group, it will, in an SPE model, it will be kept and will be funded by the parent company until the end, because it is part of the business. So I don't see that as a yes, no, or a black and white situation, because in a crisis, you have to assess what effectively first preserves the value for everybody, and particularly for the original group, and what is more possible to be performed. So I wouldn't be so dogmatic on that. But then if you are to infer that, but then if I sell, then I don't need loss absorbing capacity, etc., that is another question. Because ex ante, you have to be prepared, because we don't know what will be the likely scenario that will materialize at that moment, at the moment of the failure. And therefore, there can be cases where you have to adequately capitalize the subsidiaries, particularly if they are important in the local market, or if they develop some business which, as we said, it is complex, or it is subject to more shocks of market confidence.
Well, if I may come back to my question, and I hope you will hear it. Well, my question was similar and some slightly different, in the sense that in the current MREL policy, when a bank has a resolution strategy that is based on transfer, you consider that for the recapitalization amount, there is a reduction of the size of the bank by anything between 15 and 25% in any case. While normally those banks that have a transfer strategy as resolution strategy are generally relatively mid-sized banks, not that large ones, that have barely any ready-to-sell part, that have barely any market activities that would anyway reduce. So by the fact simply of their deterioration of their situation, whereby the counterparties would reduce their business with them, while for large banks, obviously, for large banks, well, they have plenty of subsidiaries that can easily be sold, that are not necessarily linked to their core business, and they have market activities that by definition also will naturally reduce if their situation deteriorates.
My understanding of the question is that you would like the resolution authorities to declare ex ante, depending on the type of subsidiaries, what could be the treatment at a certain point. But these, you know, first of all, it is case by case because it depends on the business model and the strategy chosen for that particular group. And then, as I said, it depends on the strategy that you are putting in place. Therefore, while ex ante you do the best for your preparation for what you think that it could likely happen, as we said today, we believe on the basis of the experience of crisis that we should have even more flexibility, which means, implies also that if I combine certain tools, this doesn't prejudge the fact that at a certain point I could have a different business shape and size of the group at the moment of resolution and immediately after.
Sebastiano, I don't know if you allow me to complement what you've just said, but to be very, very simple, for the moment, 80% of the banks are under a bail-in strategy, full stop, bail-in, unique tool. What we are saying today is that we are ready to analyze a possibility to combine with other tools. Then let's do it step by step. As we've said, I think Sofia was extremely clear about the level of preparedness. It implies a number of things, and there is no free lunch, as you said. There will be a number of steps to take. If we say, we want to combine tools. We want to be sure, based on your recovery plans, but not only, that this separability is in place. That's to say it's not enough to say that we can sell a subsidiary. We want to do it. Under full bail-in strategy, we have several weeks to prepare that. This is the restructuring plan. If we say that during the resolution weekend, we want at the same time to implement a bail-in decision and to transfer a part of the perimeter of a failing bank, it's another story. So we are not immediately ready to consider the implication on the MREL policy, but this is exactly the topic. Once we've addressed the question of combination of tools, we'll go to the translation in terms of MREL policy, obviously. But we are not yet there.
No, we are not yet there for sure. And therefore, this implies a lot of preparation ex ante and to assess whether the eventual combination of tools is credible and feasible. And then there will be a reflection on the calibration eventually. I think that it is time. You wanted to add anything else, Gonzalo? Yes?
Taking advantage, there is still 1 minute, Sebastiano. We didn't mention the term bridge bank yet, and that would complete the discussion, because I remember in that meeting, the Commission in the Berlaymont, like 2-3 years ago, is a question that I raised to you when you were in the panel, and we thought about that. And it's like one of the hidden possibilities there, because of course we talk more about transfers, but just to drop the idea, there is an objective of the banking union that has not made progress, what was the cross-border banking consolidation. And the bridge bank could be the tool that could give sufficient time for the interest of cross-border banks in foreign banks that is unthinkable in a weekend. And there is also the Financial Stability Board key attributes that contemplate the possibility of temporary funding by authorities under very severe control by the resolution authority. So the elements are there now that we have a very high level of bail-in. Without the bail-in at that level, it would be very risky. But now that we have it, if you put those three elements together, that's something we might have to explore as well.
Well, this is certainly a point that we have to reflect upon and consider. But for the moment, we are where we are. I think that I have to say, also taking the views from this panel, but we will discuss the results soon after the coffee break. It seems to me that the main points emerging here from the participants to the panel is that Sofia said, yes, we have done a good job of supervisory and resolution authorities and the banks, but clearly there is something in implementation that we have to be ready for in terms of information, of cross-border availability, also of collateral, for example, so there is room for improvement there. And in this shift from planning to testing, also the authorities are doing their job. Not only we ask to the banks to do that, but as it been mentioned by Dominique, by Sofia, we are also doing a number of exercises of different type of simulation with other foreign authorities outside of the European Union in order to be ready for different type of events. On the optionality and flexibility, there is to me that there seems to be a broad agreement, and then clearly the devil is in the detail here. There is a particular point stressed by UniCredit regarding the actionability that has to be tested, so leverage on the recovery plans, but also actionability of the strategy on the tools in terms of legality, economic rationale, of what you have in mind to do. And instead, as concerns market confidence, I take the view from UniCredit that first, I would tend to agree, at the beginning is immediately the important thing is liquidity, then comes capital, of course, for the viability of the business ongoing, and of course, the business model that has to provide enough profits in order to be credible in the medium to long term. The EBF mentioned the complexity of the macroprudential buffers and the possibility to reconsider them, simplifying maybe the framework, and also to work more, but without increasing the overall levels of requirements on the usability of buffers, which today is clearly, as we know, and analytically shown, not 100%, but lower than that. From the floor, I think, came questions regarding the different flexibility needed depending on the articulation of the group structures. As Dominique said, clearly we are have issued this consultation paper to get your views, but clearly before we speak of impacts on MREL calibration, this means to have credible, if that is the route, combined tool that can be applied. Thank you.